Okay, good afternoon, good evening. Dan Fitzpatrick here, stockmarketmentor.com and Fitzpatrick Trading Group. Um, Listen, first, before I start, if you are a former member, like if you're a former member of Stock Market Mentor, watch your email tomorrow morning. You will be receiving an email, and it's not like a marketing email. So if you get something from me, don't ignore it. Okay. I think I'll put it this way. You can thank me later. So that's that. Now, with Micron, they reported earnings after the bell. Everybody's waiting for, at least I was. A lot of people were waiting to see what was going to happen here with Micron. And the big concern was this: like after the big moves that these things have had for just so long, and all the hype, everything else. Is this going to come to an end? Is this move going to come to an end? Is it a bubble? And Micron's earnings basically told us that no, it's not. And this is one of the things that's important. I'm just gonna here. Come on, you can do it. Okay, I'm just going to talk to you here. One of the things about this space is that the build out is really super expensive, and the big issue that so many of these analysts are that so many of these analysts and talking heads are talking about is capex. That these big companies like Amazon, Meta, Google, a few others, they're spending just a crap load of money on building out their stack, building out this system. And how can they do this? Because their free cash flow is shrinking. You can see it on their balance sheets, their free cash flow. That's a bad thing because that indicates that revenue is declining, profit margins are shrinking. It's just a horrible thing when your free cash flow is declining. And frankly, that's bullshit. In this case, it is. There's no other way to say it. And this is why, because free cash flow is cash flow, meaning revenue, minus capital expenditures, capex. And so you can get, and the traditional guys don't, they're all dogmatic. They graduated from Stern School of Business or whatever, and they know certain things, but they're not generally traders, and they look at things in a certain way. But this is the deal: a company can have big drastic declines in their free cash flow if they see an opportunity and they're going like, holy hell, we got to get going in this. We got to build a moat around what we're doing here. All the money that we're bringing in, we got to spend it on that. Okay, you know what that kind of reminds me of? Kind of reminds me of Amazon. Way back in the day when Amazon was selling books and they weren't making any money. And this dude, Jeff Bezos, he had hair back then, had a nice wife back then. I liked the first one better. But anyway, the bottom line was they were spending all their money and issuing more stock, doing everything he could to do what? To get more money in so he could show that he's got great cash flow? No, that was stupid. He was getting all this money in using all of his revenue to build out things like, I know, logistics, just the type of thing that would come in handy when you're basically delivering milk and eggs to Dan Fitzpatrick and everything else to you. I can't remember the last time I was in a clothing store, but I do know this. We're going over to Europe in a month for 10 days. It's going to be a blast. My wife's buying me all kinds of new clothes for that trip. And do you know what? She hasn't gone into clothing stores either. We get it all through Amazon, and that means we can buy three different pairs of shoes to see which ones fit, return two of them, and it costs us nothing. The bottom line is this Jeff dude was an absolute brilliant genius, and his free cash flow sucked. Oh, and then what's that thing, AWS? That's another one that Bezos invested a crap load of money in. And now what we use Amazon, we use their web services deal. I would never use anything else. They've got the market cornered. They've got a big moat around what they're doing. And it all came from a rapidly declining free cash flow. So what's Amazon doing now? It's the same thing, just in a different industry. Same thing with Google, same thing with Microsoft. And Andy, by the way, our resident expert on all things AI, has been with Microsoft in their AI department for division for, I don't know, 6 or 7 years. And he and I are going to be doing a webinar on Friday morning. He doesn't know this yet, this part of the webinar, but I'm going to have him spend some time explaining to people exactly how all of this stuff works together. So if you're an Option Market Mentor member, I think you got to be there. Anyway, so the bottom line, though, is these big companies are spending money. They're spending a massive amount of money on this, and we can see that in the way these stocks are trading, in the way they're reacting. So you're going to have stocks like let me show you, I'll show you my screen again. So you're going to have stocks like Micron just continue to move higher. And yesterday, because of Korea, the Kospi and SK Hynix, it really, really took, I think the index went down 10%, which is a big deal. And so it knocked everything down. Well, we're not back to where we were before. This is still down 8%, so it's got a ways to go. But because of Micron, it's going to run. This should run back up, and we're going to continue along the 20. Similarly, with Micron, this will hit a new all-time high tomorrow, no question about that. Seagate and Western Digital. So these things are all doing really well. And that really just obliterates this whole bear version of this is a bubble. Oh, I'm getting, and you hear this a lot too from old farts like me, oh, this reminds me of the bubble in 2000. Yeah, the internet bubble. We were in the infancy back then. Was there an internet bubble? Sure. When you've got a website called theglobe.com and it has no business model whatsoever, but it does have a .com, that was kind of stupid. A lot of these companies never made a dime, but their business model was incinerating as much cash as investors would give them, and they executed their business models flawlessly. This is not that. These companies make money, and they make a lot of them. You can understand the technology, you can know where it's going. Now, ultimately, these stocks, and I think Micron will probably be the canary in the coal mine, which, by the way, the canary's doing just fine still. But these stocks will ultimately tell us when the market has topped, when the bubble, and I don't think there is a bubble. I just think there's a bunch of pissed off people who wish they got in down here and they didn't, and now they're mad. And so they're saying like, oh, the stock's up. These are frothy. They're up too high. So it's a bubble. Oh boy, are you people going to lose money when this rolls over? And all they're really doing is they're just pissed off at themselves. They don't think this is going to end. And it's not anytime soon. So what I'm telling you is these are still stocks that you want to be in. I was just talking in my strategy session about this. I was actually talking about TG Therapeutics as far as when we got in. And I was saying, look, if you didn't get into something early, but you still want to buy it, the question isn't, geez, I'm not getting in early. What am I going to do? No, you didn't get in early. Embrace the horror. The question is, am I in too late? Am I buying too late? Because there's only one chance to get into a stock early, and that is either just before it breaks out or just after it breaks out. But if the breakout is real, you're going to have plenty of time to hop on the bandwagon after it gets going. So your question isn't like, oh crap, what do? I didn't get in early. Your question is, if I get in now, am I getting in too late? And the more your answer leans towards, I think it is too late, the more cautious you should be. Okay. In a bull market, though, we want to be aggressive. We want to be aggressive. I'll say it again. You want to be aggressive, but with your aggression, you always have to temper that with risk management. And what I mean by that is you can be really, really aggressive in a trade, but just make sure that you've got a stop that defines what your loss is. Because if you take a big loss, it can take you out of the game for months, years, or just permanently if you take a big loss. And I've seen people do that, and it kind of breaks my heart. So go ahead and be aggressive. Be aggressive in what you're doing, but never discount risk. Every single trader that's a champion trader, that's a world-class trader, a world beater, every single one of them does the same thing. They think about risk first. Always risk first. Once you define your risk, you're good to go. Think about a race car driver. If they know the guardrail around the cliff, they know it's solid, they know it's not going to break no matter how hard it's hit, they can really step on the gas and go around that corner because they know what their risk is. The risk is a dent on the right side of the car. They know they're not going to slide off the hill. Think about your trading that way too. Make sure you've got guardrails up so you know what your maximum risk is, okay? All right, guys, that's all I got for you. Members, doing that webinar tomorrow at 8:30 a.m. my time, 11:30 Eastern. Yeah, I think it's at 8:30. I'll let you know. It's either at 8 or 8:30, one of the two, but I'll let you know tomorrow. All right, take care.